So when it comes to the compounder curve and Medtronic, where would I place them against all of the other companies that were analyzed on the channel in the past year? I would say Medtronic is Medtronic Stock Analysis, ticker symbol MDT. Now, between you and me, this company has a very fascinating backstory. When Medtronic's founder, Earl Bakken, was only 8 years old, he watched the 1931 movie Frankenstein and became fascinated by how electricity could create life. And that single spark drove him to study electrical engineering in college, and he later used that exact concept to invent the world's first wearable battery-powered pacemaker. Now, I spent a ton of time digging through their 10K, listening to their previous earnings calls, and dissecting their financials and fundamentals. So in this video, I'm going to be breaking down my full analysis on Medtronic, and more importantly, what I think the fair value estimate should be for their stock price. And by the way, my name is Amos. Welcome to the channel, Dividend Compounders with Cheese. If this sounds good with you, let's go ahead and get into it. So what exactly is Medtronic and how do they make revenue? Medtronic is currently the world's largest medical device company by revenue. They're headquartered in Dublin, Ireland, with operational roots in Minneapolis, Minnesota. In other words, they sell equipment that doctors use every single day and products that help treat chronic diseases. The cardiovascular portfolio, which includes pacemakers and heart valves, makes up about 37% of the top line. Their neuroscience arm of the business makes up about 29% of gross sales, and surgical equipment and robotics makes up about 25%. And then last but not least, diabetes, it makes up about 9% of the revenue. And about half of their sales come from the American audience, with the rest coming internationally, including China and India. And if you work in a hospital setting, then you know the equipment has disposable accessories and recycling timelines. You can't use them forever. So they're constantly making money and durable cash flow. And switching costs are very high because hospitals train staff on Medtronic systems and integrate them deeply into surgical workflows from A to Z. You can't just interrupt and bring in the competition's equipment and start all over again on a random Monday. It doesn't work like that. And a fun fact is that most former D1 athletes, they usually get into medical device sales and they partner with trying to convince doctors to use their equipment. It's just something that I understand because a lot of my friends who played lacrosse and football, they're still in the medical device sales space. And now let's go ahead and talk about the recent developments surrounding Medtronic. So, remember how we talked about diabetes being the smallest contributor towards the top line? Well, they divested it back in March, meaning they sold it off. So consequently, they lowered their full year earnings per share guidance to account for one-time separation costs and mergers and acquisition related charges. And a fun fact is that the diabetes business is now their own publicly traded company known as MiniMed. And something else that happened to Medtronic in April is that they acquired CathWorks, a software company that expedites the decision to do open heart surgery or to insert a stent into the heart. And my takeaway from that is it's very good to diversify their business from having hardware sales of equipment to implementing more software that has recurring revenue. So I think this is a step towards the right direction for this conglomerate of a medical tech company. And then, believe it or not, it's not just the United States that's suffering under economic hardships and inflation. China used to be the big tailwind for everybody involved in growth. But China's economy and hospital spending is slowing down considerably, especially because the CCP, the anti-corruption crackdowns, are happening right now. So China is no longer the Cinderella growth story for Medtronic. Also, with Nike, Starbucks, and most S&P 500 blue chip companies, China is no longer that guaranteed 5 to 10% boost to the gross sales. And now it's time for the cheese situation. What are the three big considerations when it comes to Medtronic? Number one, we're getting old, and we have to talk about it. The aging population. As people live longer, medical treatment to help them in everyday life almost becomes a growth catalyst, especially when you take into account roughly 10,000 Americans turn 65 years old every single day. Not to mention, we're living longer than before. And then number two, the weight loss drugs. Fact of the matter is, a lot of the chronic diseases people deal with are directly tied to being super fat or having a big waist. And as of right now, 13% of Americans take one form of a weight loss drug or another. 13%. And in the near future, on a conservative estimate, 25% of Americans will be taking them, which directly reduces the amount of people dealing with a chronic illness such as diabetes. Unless, of course, 5 years down the road, we find out about the long-term consequences of taking GLP-1 drugs, causing drastic consequences such as a third nipple forming on your forehead or something. And at that point, I feel like everyone's going to hop off GLP-1s, but that is not the case right now. And then consideration number three, the health insurance bull run. Of course, a partial reason as to why health insurance stocks like United Health, Humana, Elevance, they're soaring these days, right? It's not just because of the Medicare reimbursement rate being better than anticipated. It's called the Inflation Reduction Act. I think that's the bigger reason as to why they're soaring. And the new Medicare Part D caps, it restricts drug profits, which means health insurance companies get to protect their margins. And although it's focused more so on drug pricing, investors are absolutely terrified that elective or quality of life procedures like certain heart valves or spinal implants, it's going to face tougher pre-authorization hassles because the health insurance companies will look to cut costs where they can, and they're starting to get approval to do just that. If it's not a medical necessity, the what if is people will have to jump through hoops and loops to get their treatment approved. And medical device companies are vulnerable because many of their highest margin procedures, unfortunately, it lives in that gray area between life-saving and quality of life improving. So yeah, welcome to the healthcare system in the United States. It's broken. We definitely need reform. It doesn't matter what side of the aisle you are on. We need some change. Because if you visit Europe or Japan, Korea, the healthcare system is so much more efficient and optimized. It just drives me up a wall how we have such a thing as medical debt here in the US, where if you have cancer and you need a treatment, you could lose all of your life savings and go belly up from that. It just, it irritates me. But moving on, let's go over Medtronic's report card, their financials and numbers. The first one that we are going to address is their financial performance, and it's going to be predicated upon their P&L, their margins, consistency, and share buybacks. The most important metric here is their gross sales, also known as their revenue. And there are some down years here and there, but it's slow and steady up and to the right if you zoom out and take a look at it from a bird's point of view. No, they're not pulling off numbers like Nvidia or AMD, but that's because this is a more established, mature company. And the margins across the board, I would say it's pretty stable, especially in light of the tariff situation. So to me, that's pretty impressive. And they've been buying back the shares, at least they have been for the past 10 years. And the return on invested capital, which is a metric that I really care about, it's good. It's greater than their weighted average cost of capital. My only knock against them is the consistency of their earnings. So their EPS, their profits per share, the bottom line per share, or lack thereof. It trends in the right direction, but it's up and down like waves. There's peaks and valleys, and that's because this company, every handful of years, they go through M&A activities, but also due to one-time tax implications, But if you take a look at it from the cash flow situation, it's not too bad. So overall, I would say a B. Now moving on down to the balance sheet, their cash position is pretty healthy, and they keep their total debt at about $28 to $30 billion every single year. So I'm assuming that's their target range, because you'll have some companies out here where it'll be $25 billion year over year, and then magically it turns into $500 billion. Hi, I'm talking to you, Oracle. But it makes sense, right? They're trying to become a one-stop shop for OpenAI and becoming their host, their server, and building out all of their data centers. So I get why that's happening, but I digress. And their debt to EBITDA ratio is a 2.8, so it seems pretty standard and healthy to me. It's good. So I would say a C+. You might be like, wait, what? You just said it's healthy and it's standard. Of course. So they get a C. That's about what a company should be doing. Now, if they had no debt and no loans on the books and their cash situation was growing and it was beautiful and it was bulletproof, like off the top of my head, Cal-Maine, the chicken egg commodity business, then it would be like a A. But a C+ is still pretty darn good. Now, moving on down to the dividend safety, their dividend profile, I think this is one of the reasons why investors look at Medtronic. It's satisfactory, like eating a burger when you're hungry. And you know, two will get the job done. So it's kind of like, it gets the job done. You know what I'm saying? It's not the best in the world, but it's not the worst. And I say that because the growth rate year over year is 1.4%. So it just shows you that the leadership's confidence in forecasting their EPS growth for the next 12 months is not the highest. But hey, they've been growing their dividend for the past 50 years. And that's something you really do got to take into account. And it's absolutely sustainable because their free cash flow situation is beautiful. So the payout ratio based on a GAAP basis of their EPS is 79%. Perfectly fine for a mature established operation like Medtronic. I would even say up to 80-85%, like if you're Altria, the tobacco giant, it's fine. And based on their free cash flow, it's 67% if you were to bake in the dividends per share by the free cash flow per share. So I can't see their dividend getting cut anytime soon. It's good. So a B-. And then last but not least, the valuation. Medtronic usually trades for about 27 times their earnings. So their PE ratio on any given year on average, usually a 27. Or at least they have been for the past 20 years. Right now, it's a 21. So what that tells me is that the market is pricing in slower spending for hospitals and replacing equipment, elective treatment through health insurance, and a healthier population due to GLP-1 drugs. And here's the crazy part. Fun fact, their forward PE ratio is usually 18. Right now, it's 13. So it doesn't matter how you spin it, manipulate it, it doesn't matter. On paper, based on their own timeline and on their own data, they're cheap. But we can't say that for sure unless we figure out their inherent worth. So that's exactly what we're going to do now. Now in the next portion of the video, we're going to be calculating an inherent worth price for Medtronic based on their own numbers, data, financials. Doesn't matter what the market thinks. What is their fair value estimate? Now, based on the GARP formula, on a 3% growth rate for their revenue, they should be $70.77. They're roughly $76 right now. However, on the flip side, if their revenue were to grow at 8%, then Medtronic should be $113 a share. Taking the leadership's guidance into account, they're forecasting at least, at a minimum, 5.5% growth in their revenue. So, baking in 5% growth rate, then Medtronic should be $85.77. So based on the GARP formula, which I created, Medtronic is undervalued. Now, the next one is the dividend discount model. Now, baking in that their dividend will grow at 3% year over year because their 5-year growth rate is 4%. Now, year over year, it's only 1.4%. So we don't know which way it's going to go. But if it gets back up and it trends in the right place, 3%, then Medtronic should be $83.58. Now, as a sanity check, we're also going to do the Graham's valuation. And it says $61.07. Now, between you and me, that seems a bit too bearish and an outlier result. So we're only going to take into account the GARP formula and the dividend discount model. So roughly $84 and some change. So if I were to buy into Medtronic today, roughly $76, the upside would be 11% to their fair value estimate of $84.68, which brings me to the buy zone with a dollar cost averaging mentality and tactic. If I absolutely had 100% conviction into Medtronic and I wanted to go gung-ho into them, this is probably what I would do. A good price to open up a position to start that entry point where I put about 10% of my capital would be $75. Now, because they are on a downward trend, I do think we're going to see $75 very soon. Maybe in this next upcoming week, maybe in the next month. Now, once they hit $67.44, I would say that's the bargain price, where the margin of safety, the upside from $67 to $84 is pretty darn good. So applying that same dollar cost averaging mindset, this is where I would go 25% of the capital into Medtronic. Now, a steal of a price where I back up the truck and I load up and I go gung-ho all out, $59.27. But please do keep in mind, that's not financial advice. And now, friends and family, it's time for the compounder curve. And the first one that I want to address is their grade. What do they deserve? How good is this business? I would say Medtronic, it's the definition of a boring but necessary business model. I think the fear that's surrounding the medical device landscape, I could be wrong, but I think it's overblown. Just like vibe coding, sending all the software stocks deep into the red, I also think this is a generational buying opportunity for the tier 1 and tier 2 SaaS stocks. But that's neither here or there. So when it comes to the compounder curve and Medtronic, where would I place them against all of the other companies that were analyzed on the channel in the past year? I would say Medtronic is in the C tier. Now, I went back and forth whether or not they were in the B. Ultimately, I think it's a C+, B-. I wouldn't be mad if they were over here as well, right next to Waste Connections. And something interesting about Medtronic, when we take a look at their stock market performance, baking in their dividends plus the share price appreciation, Medtronic is represented by the orange line. The S&P 500, commonly referred to as the market, the blue line. That's the standard, the benchmark. Up until 2022, you can see that Medtronic outperformed the market. Kind of interesting, right? And that's when everything changed. Because prior to that, their pricing power and people were eating fast food like there's no tomorrow. After inflation and everything else started happening, you can see that Medtronic has been severely underperforming the market. But if we were to stop this timeline to right there at the end of 2021, Medtronic's CAGR would be better. Baking in the past 4 years, let's see how it shakes out, their maximum. So the CAGR is still 13%, which is good. But by just investing into the S&P 500, you would have gotten 14.9% year over year. And just for fun, if we were to manipulate the data and just cherry pick the timeline, if we were to stop, I guess, in the summer of 2021, you could see Medtronic's total return up until that point, 420%. The S&P 500, 405%. Well, that's when the tides have turned, and now S&P 500, 791%. So who do I think this stock is for? I think Medtronic is a defensive growth compounder. It really is, because if you take a look at the data, it was pretty good up until 2022 because it operates in healthcare. And I'm pretty bullish about that. And that's because by 2033, it is predicted that more than 1/5, 20% of the entire US economy will be dedicated to healthcare, taking care of all the baby boomers that are 80, 85 years old. And I think Medtronic, it's a low risk dividend payer. That can make sense in an income portfolio because the dividend yield is pretty respectable, right? It's above 3%. Or I guess someone looking for a rebound rally. And if you really think that Medtronic is going to go belly up or go bankrupt, like potentially gambling.com in the F tier or Carter's baby clothes, you are delusional. For crying out loud, Medtronic generates $35 billion of revenue per year, and it's only growing. A company at that scale and the reach that they have in the healthcare system, it's not going anywhere. So coming on over to the cheese rating. Do I personally want to own Medtronic? Do I see them as delicious? Are they decent or are they moldy cheese? Well, I do like the business, but in the medical device sell-off, when everyone is getting punished 10, 20, 30%, and they're all in the red, like what's happening right now, I would prioritize Abbott Laboratories because they have diversified revenue streams from meal replacement drinks, Pedialyte from when you're super dehydrated, generic drugs from the AbbVie legacy portfolio. That's really important. I don't think of Abbott as a big pharma company because they don't spend billions of dollars on research and development to come up with the next blockbuster drug. Abbott makes the generic Tylenol, the allergy pills and stuff like that. And Abbott also does hospital equipment and stuff that goes inside of your body and in your heart. So I would pick Abbott. But a close number 2, like in second place for me, would be Medtronic. I'm serious. I would pick Medtronic over Edwards Lifesciences or Boston Scientific. Maybe Stryker, maybe not. Maybe Stryker would be tied with Medtronic in second place. So if you buy Medtronic or if you're invested into them right now, I can't fault you. It's a pretty decent company. It's a dividend compounder that's just unfortunately running into some smelly headwinds. Tariffs, hospital spending cooling down, fat people getting skinny, and everything else. It's the perfect storm, and I can see why they're selling off for the past 4 years. But with the same logic that I applied to Abbott and why I invested into them, it can be applied here. Why buy a company when they're overvalued and near all-time highs? Why not buy a high-quality compounder when they're on the operating table and they're going through surgery and there's a lot of fear surrounding them while they still print cash and they have a healthy P&L that generates $35 billion of revenue? Friends and family, they're not just making $1 million, $10 million. Dude, they're making $35 billion of cold, hard cash. Now, I think in the past, leading up to the weight loss drugs, their products really did help the fat people. But I think Medtronic's offerings, they still hold value to the elderly, the ones that are going to be 75, 85 years old, who face unavoidable age-related wear and tear. Likewise, when you buy a used car that's like 50 years old, even if it was kept in a pristine condition and it drives well, the rubber and the plastics that are all over the engine, they do tend to crack and show signs of breaking down. Likewise, the human body is just like that. Even if you take care of yourself and you work out and you eat healthy, things do break down. So you might be able to use those wonder drugs to shed weight at age 20 or at age 40. I'm talking about GLP-1 drugs here, but you cannot stop a heart valve from calcifying or a spine from degenerating at age 75 because you joined the military at age 18 and you went on freaking ruck marches 25 miles with 70 pounds on your back. Like, no, that's not going to do any damage to you. The market thinking the GLP-1s will completely dry up the patient pipeline for Medtronic and Abbott Laboratories, I think they're super delusional because they forgot, right? They're not taking into account the massive aging baby boomer population entering their peak years for surgical interventions. Dude, you fall down at the age of 7, you can get right back up. You fall down at the age of 85, you're going to need a hip replacement. And I'm not even trying to be funny, that's the reality. Medical device and equipment and hip replacements and artificial kneecaps, it's a reality when you become old. No amount of weight loss eliminates the long-term demand for structural medical tech and medical device companies. That's why I'm investing in it. Then again, I'm not a doctor. I'm just a contrarian investor who loves looking for hidden value in industries the market is currently panicking about. When everyone thought that United Health was going to go belly up, I bought into the fear. Likewise, when DeepSeek came out of China and everyone was like, dude, AMD, NVIDIA, they're doomed, and they went on a 40-70% sell-off decline, I bought into that. So I'm that kind of guy. So I don't know. I'm either going to be right or I'm going to be wrong. Now, needless to say, please do keep in mind that I am an idiot. All of the information in this video is wrong and inaccurate. So please do your own research and due diligence so that you can form an opinion on Medtronic. Just because I made a dedicated deep dive video on the stock, it does not mean I endorse or recommend it. Now, having said that, if you appreciate this type of deep dive research and analysis and want to keep the lights on for this YouTube channel, please do consider joining Patreon. Because up on the Patreon, you'll find my weekly buys and sells and exclusive research that never finds its way onto YouTube. Having said all of that, I love you guys. Stay safe, good luck in the stock market, and let me know how you feel about Medtronic. See ya.